Welcome to the debate. Today we are dissecting the 2024 annual report of Kingston Properties Limited, or as most people know it, KPREIT. This is a company at a really fascinating intersection right now. It's a Caribbean-based real estate investment trust with a portfolio that has now officially gone global, spanning Jamaica, the Cayman Islands, the U.S., and now, for the first time, the United Kingdom.
It is, and that portfolio looks impressive on a map, I'll give you that. But, as any seasoned investor knows, geography isn't the same thing as strategy. We're looking at a year that was defined by high global interest rates and a really shifting commercial real estate landscape. So the central question for me isn't just about where they're buying, it's about how they're managing what they already own.
Exactly. The core tension we're examining today is really between KPREIT's, let's call it aggressive global ambition, and its operational realities on the ground. They have this motto, buy local, own global. Is that strategy a masterclass in resilience that's actively protecting shareholder value? Or is this expansion just masking some underlying risks around vacancies and rising costs?
I think you know where I stand on that one. You see a masterclass, I see a management team that might be spreading itself a little too thin. I'm looking at the core metrics, specifically occupancy, and I'm seeing some warning lights flashing.
And I'm coming at this from the view that KPREIT's 2024 performance is really a testament to successful strategic execution. When you look at the 15% share price growth in an otherwise flat market, the entry into the UK, and record net profits, well, the diversification model isn't just working, it's thriving.
We'll see about thriving. I'm here to pump the brakes on that enthusiasm. I'm looking at the higher than anticipated vacancies that are admitted right there in the report, the impact of increased borrowing costs, and frankly, a dividend yield of 2.7%. I'm asking if the complexity of operating across 4 distinct jurisdictions, 4 tax codes, 4 legal systems, is actually paying off for the shareholder in cold hard cash.
All right, let's dive right in then. For me, KPREIT in 2024 delivered exactly what a REIT is supposed to. Resilience and growth. The headline number is just undeniable. Total comprehensive income surpassed the $5 million threshold for the first time, specifically hitting $5,374,000. That is not a small feat in this climate.
It's a big number on paper, I will grant you that. But we do need to peel back the layers on how they got to that number.
And we will, but let's just stick with the market's reaction for a moment. It's backed by real asset growth. Total assets under management have swelled to over $86 million. But what I find most compelling isn't just the internal accounting, it's the market validation. The volume-weighted average price, the VWAP of the stock, increased by 15% year over year.
Right. And just to clarify for our listeners, VWAP isn't just the closing price. It's the average price the stock traded at all day, weighted by volume. It's a much better measure of what real investors were actually willing to pay.
Exactly. It shows true market sentiment. And that VWAP grew 15%. Now, compare that to the JSE Main Index, which only grew by 3% in the same period. The market is voting with its wallet, and it is voting for KPREIT. This tells me that the buy local, own global strategy is successfully navigating this high interest rate environment through smart refinancing and, some bold moves like that CIBC-backed acquisition in the UK and the downtown Kingston sale and leaseback.
I see why you think that. And look, the stock performance is a win. I won't deny it. But let me give you a different perspective. You're looking at top-line growth and share price, which can be driven by sentiment, by future expectations. I'm looking at the engine room, and I think I hear some knocking. The report explicitly admits to higher than anticipated vacancies in specific properties. It mentions the need to creatively adapt vacant spaces. That phrase, it really jumps out at me. Creatively adapt is often just corporate speak for, we can't find tenants for this space.
Or it's speak for proactive management in a market that's changing. Office needs are changing. You can't just let the space sit there, you have to adapt it.
Perhaps, but the numbers don't lie. The quick facts section lists occupancy at 83%. Now, for a REIT, having 17% of your portfolio sitting empty is a significant drag. That's 17% of your assets generating zero revenue but still racking up maintenance costs, insurance, property taxes. And while you celebrate the rental revenue growth, The report also flags moderate increases in operating expenses and higher year-on-year borrowing costs.
But expenses went up everywhere. That's inflation. You can't pin global inflation on KPREIT's management.
True, but when you combine inflation with vacancy, you squeeze the margins. And let's talk about that dividend, a 2.7% yield with a payout ratio of just 27%. In a world where risk-free fixed income like U.S. Treasuries or even local government bonds was offering 5, maybe 6% in 2024, I have to ask if the mission of generating extraordinary returns is actually being met. If I can get 6% from the government with zero effort, why am I taking on real estate risk for 2.7%? My argument is that the expansion is distracting from optimization.
That's a fair challenge on the yield, but have you considered that the expansion is the optimization? Let's look at this geographic diversification. You seem to view it as a liability, as a distraction. I view it as the ultimate hedge.
I view it as a liability at this stage because of the scale. You have a company with $86 million in assets, which is respectable, sure, but in the world of global real estate, that's microcap. Yet they're trying to manage compliance, tax laws, and property maintenance in Jamaica, the Cayman Islands, the USA, and now the UK. That is a massive administrative burden for a portfolio of that size.
I completely disagree. The entry into the UK market isn't just flag planting, it's a strategic hedge against currency risk, against economic cycles. The report notes this was a $21 million acquisition backed by CIBC. That shows institutional confidence. I mean, a major Canadian bank is not lending that kind of money for a UK acquisition unless the numbers work. By entering the UK and at the same time entering the downtown Kingston market, they are decoupling their risk from any single economy. If the US market softens, maybe the UK or Jamaica strengthens.
But what's the cost of that spread? You have to maintain legal counsel in 4 jurisdictions. You have to understand landlord-tenant laws in 4 jurisdictions. The report mentions they are dealing with vacancy issues while trying to integrate a whole new market. Is the management team stretched too thin? You can't just fly to London to fix a boiler or negotiate a lease renewal.
Well, they aren't fixing boilers themselves. They have property management teams. That's standard industry practice. And look at the evidence of their activity. They aren't just hoarding assets. They disposed of units at the Tropics Center in Cayman. They completed Gumtree 5 and got it leased. This is active portfolio churning. They are selling mature assets to buy high-yield growth assets. That is the definition of efficiency.
I'm sorry, I just don't buy that the churning is purely strategic efficiency. When you have 83% occupancy, that 17% vacancy implies that some of those mature assets might just be, well, underperforming assets. You mentioned the downtown Kingston sale and leaseback. And that's a good deal structure, I will admit.
And let's explain that for the audience quickly, because it's a key part of their strategy. A sale and leaseback is when KPREIT buys a building from a company, and then that same company immediately signs a long-term lease to stay in the building as a tenant.
With a tenant already inside, the cash flow starts on day one. But does that one deal make up for the fact that they're having to creatively adapt space somewhere else? Diversification protects you from economic downturns, yes, but it doesn't protect you from operational inefficiency. If you have empty buildings in Miami and empty buildings in Kingston, you just have a diversified portfolio of empty buildings.
That is a harsh characterization. Let's look at the financials then, because I think they tell a story of performance despite those headwinds. We need to talk about the funds from operations, or FFO.
Go ahead, make the case for the cash flow.
FFO is the holy grail for REITs. For those listening, net income can be misleading because it includes depreciation, which is a non-cash charge. FFO adds that back in to tell you how much cash the property actually generated. KPREIT's FFO stands at $2.5 million in net cash from operations. Rental income grew from $3.8 million in 2023 to $4.7 million in 2024. That is nearly $1 million increase in rental revenue year over year. That is not corporate speak, that is cash in the bank. And crucially, despite the shift in global interest rates, the report states they successfully refinanced loans. That proves financial agility.
That rental income growth is visible, yes. But let's look at the bottom line of that P&L statement. You celebrated the $5.3 million in total comprehensive income earlier, but a significant portion of that comes from fair value gains.
Which is standard accounting for real estate.
If the building is worth more this year than last year, you record that gain.
It is standard, but it is not cash. It's valuation modeling. It's paper money. Let's be clear. Fair value gain means an appraiser says this building is now worth X amount more. But until you actually sell the asset, you can't use that money to pay a dividend, and you can't use it to pay down debt. If you strip out the fair value gains and look at the actual cost of doing business, the picture is much, much tighter. Operating expenses are up, borrowing costs are up, and there's a tax charge of, $25,000? It's small, but it's there. My concern is that they are relying on property appreciation to boost the profit figure, while the actual margin on leasing, the spread between rent and the cost of debt and maintenance, is shrinking.
I would frame it differently. Fair value gains are a recognition that the strategy is working. The assets they are buying are becoming more valuable. You can't just dismiss appreciation in a REIT. Capital appreciation is half the value proposition. Investors buy real estate for two reasons: rent checks and price appreciation. KPREIT is delivering big on the appreciation side. And regarding the borrowing costs, they're managing a debt-to-equity ratio that allows them to grow. If they were too conservative, we wouldn't see that 15% share price growth.
But we might see a better dividend yield. That 2.7% yield is painful. If I'm an investor, why am I taking on the risk of vacancies in Cayman and the UK for 2.7%? I could put that money in a boring bond and sleep soundly.
Because with the bond, your principal creates zero growth. With KPREIT, you get the 2.7% yield plus the 15% growth in the net asset value. You're buying a growth engine, not just a savings account. But let's pivot to something that impacts the bottom line in a different way, something KPREIT is emphasizing heavily: sustainability and ESG.
Here we go. The green premium.
It is not just a premium, it is a value driver. You might call it box checking, but I call it rigorous cost control. KPREIT has achieved gold status with the Green Business Jamaica program.
Which is a nice plaque for the lobby, I'm sure.
It is so much more than a plaque. Look at the data in the report. They achieved a 25% reduction in energy consumption at the 52-60 Granada Crescent property. That saved 8.4 million Jamaican dollars. That goes directly to the bottom line. That increases the net operating income. And they have a planned solar electricity project at Red Hills Road. This is future-proofing the assets against rising energy costs. And in Jamaica, where energy costs are some of the highest in the region, this is a huge competitive advantage.
I come at it from a different angle. 8.4 million J is great. I applaud the efficiency. But let's just do the math. How much rental revenue is lost from a single month of vacancy on a prime commercial unit? It likely dwarfs that saving. My point is about focus. While the team is managing recycling bins at an early childhood center, which is socially responsible and lovely, and chasing gold status, they have 17% of their square footage sitting empty.
I think that's a false dichotomy. You can walk and chew gum at the same time. You can save energy and lease buildings. In fact, they support each other.
Can you, though? With a small team managing 4 jurisdictions? The corporate governance rating is 87%, which is an A rating. That's commendable. But governance and ESG scores don't pay the rent. Tenants pay the rent. If you have higher than anticipated vacancies, it suggests the product isn't meeting the market, regardless of how energy efficient the light bulbs are.
But tenants today demand ESG compliance, especially in the UK, and when you're dealing with multinational tenants in Jamaica, international companies have their own mandates. They often cannot lease a building if it doesn't meet certain green standards. The solar project and the green certification make the buildings more leasable. That is the strategy to fix the vacancy.
It's a nice theory, but until I see that occupancy number tick up to 90–95%, I see ESG as necessary overhead, not a primary value driver. It's just table stakes now, not a differentiator.
Let's discuss the strategy that ties this all together. The report refers to their nimble strategy.
Nimble. That's a word that does a lot of heavy lifting in corporate reports.
It's an accurate description, though. It refers to the ability to shift the portfolio quickly. The downtown Kingston acquisition was a sale and leaseback, as we discussed, but the report also mentions a macro trend. Financial institutions are shifting from property ownership to tenancy. Banks don't want to own buildings anymore. They want to lease them so they can use their capital for banking. KPREIT is positioning itself to capture that.
They aren't stuck in legacy assets. They're moving where the market is going.
See, I interpret nimble in this context as reactive. When I read about the need to creatively adapt vacant spaces, that implies they have space that nobody wants in its current form, so they're scrambling to figure out what to do with it.
That is such an uncharitable reading of adaptation. Real estate is dynamic. If a warehouse district becomes a tech hub, you adapt the building. That's just smart business.
Is it? Stability in a REIT, the boring part that investors usually love, comes from long-term leases with boring tenants. It doesn't come from constant portfolio shifts, complex deal structuring, and entering new continents. Nimble works for a tech startup. For a real estate trust, I want solid. I want predictable. And right now, with 83% occupancy and entering a volatile UK market, Nimble feels like they're trying to outrun their own operational drag.
I strongly disagree. Solid in 2024 meant stagnant. The companies that sat still got crushed by interest rates. KPREIT moved. They refinanced. They bought in the UK to get exposure to the British pound in a different property cycle. They sold in Cayman to realize gains. That movement, that nimbleness, is why they have record profits. If they had sat still, we'd probably be looking at a loss.
Paper profits, mostly. And let's talk about that UK expansion one last time. They are buying in a market where they don't have boots on the ground in the same way they do in Jamaica. They're relying on third-party managers. That eats into margins. And if the UK economy takes a nosedive, which is not impossible, they're exposed.
But they are backed by CIBC, and they're buying in a market with strong legal protections and high liquidity. If they need to sell a building in the UK, there's a massive market of buyers. That liquidity is valuable. Compare that to selling a large commercial building on a smaller Caribbean island. It can take years. The UK entry buys them liquidity.
It buys them liquidity, but at the cost of complexity. And complexity is the enemy of execution. Every time you cross a border, you add a layer of friction.
And I'd argue that every time you cross a border, you add a layer of safety. If a hurricane hits the Caribbean, the UK assets are untouched. If Brexit causes chaos in London, the Miami assets are fine. That is the definition of a portfolio.
That's fair, but let's bring it back to the shareholder sitting here today. Does that safety justify a 2.7% yield?
It justifies the growth. The shareholder isn't just getting the yield, they own a piece of a company that is worth significantly more today than it was yesterday. The net asset value per share is rising.
As long as the valuations hold up. We've seen commercial real estate valuations fluctuate wildly in the U.S. recently. If those fair value gains ever reverse, that profit evaporates pretty quickly.
But KPREIT isn't holding risky, speculative office towers in downtown San Francisco. They're holding mixed-use, industrial, and strategic assets. The downtown Kingston property, for example, is in a regeneration zone. That's an upside play.
Regeneration zones are high risk, high reward. Again, it's not the boring REIT play.
Okay, we are approaching the end of our time. Let's bring this to a conclusion.
I'll wrap up my side. Look, KPREIT is profitable. I won't deny that. And the governance is strong, but the red flags are in the details. You cannot ignore an 83% occupancy rate in a high-interest environment. That is expensive, empty air. The higher-than-anticipated vacancies admission is probably the most honest and telling line in the whole report. So my view is that the company should pause the global expansion, stop buying in the UK, stop looking for the next deal. Focus on filling the 537,000 square feet of buildings you already own. Ensure the core portfolio in Jamaica and Cayman is airtight. Global reach is expensive, and right now, the operational cracks are showing.
And I see a company that has successfully graduated from a local player to a global contender. KPREIT is outperforming the market, a 15% stock rise versus a 3% index, because they are bold. They aren't waiting for perfect economic conditions. They're creating value through activity. Net profit is at a record high over $5 million US. Assets are closing in on the $100 million target. The move into the UK and the focus on ESG cost savings proves this is a modern, future-proofed REIT. They offer investors safety through diversity. If one market falls, the others hold. That is the definition of resilience.
It's certainly a definition of ambition. Whether that ambition pays the dividend check next year remains to be seen.
And that is the nature of the market. KPREIT stands at a very interesting crossroads of Caribbean roots
and global ambition. We'd encourage you to read the full annual report to look at the specific property portfolio details and their risk management strategies yourself.
Indeed. There is always more in the fine print.
That brings us to the end of this debate. Thank you for listening.